Hey traders, Happy New Year, by the way. In this video, I'm going to talk about some of the reasons that I was starting to get a little defensive here. I did this post on the 21st, and you can't really see them, but the two that I want to talk about here are no new stocks breaking out to fit my chart profile, and market timing remains mixed. Since then, my market timing signal has realigned the upside. So this was on the 21st, and as I said, I was starting to get really defensive there. Not shorting, just getting rid of pretty much all my long positions. And so this was the 20th after the close of 20th, and then the markets reopened. And you can see since then, that was about 41.35, 41.40. We're up about 35 ticks on the NASDAQ from there. And in my opinion, not a whole lot has changed in terms of my view. I just think that we're in a really extended market. I'm going to show you some charts here to kind of paint this picture of a market that really needs to pull back. I really felt like the Fed really interrupted this correction right here, and you can see since then it's just been a melt up. Let me show you the Dow chart. This rally right here reminds me a lot of this rally in terms of the slope and the duration, how long it took. Now, I'm not suggesting we're going to get this. I do think we could get a bit of a pullback down to about 16.1, and that would be nothing really, in my opinion. It could be more. I do think that and I'm not suggesting at this point to go short by any measure, because my timing signals are up. I just feel that they're up and they're at the tail end, and because I don't really see any stocks that I'm interested in buying right now, I'm taking a very cautious approach. In my opinion, being aggressive would be buying a lot of new stocks long here or shorting right here. I think both of those would be rather aggressive moves, because as you all know, when we are overbought, we can just as easily continue to drift higher for a lot longer than you think is possible. But there are some signs that suggest here that the markets are really at an area where a pullback is necessary. You can see here, this is the NASDAQ, and then behind here you've got the McClellan oscillator, and you can see how it's making a series of lower highs here, and yet this just continues up. The VIX, I thought this was a pretty cool chart. This goes back to 2001, and you can see here this action, or rather this activity on the indexes on the VIX looks a lot like this in terms of how it's really kind of worked its way down. Now this can go on for years, right? So it's not that we're approaching any type of, this was the financial crisis. This was the beginnings of it, but you can see that we are at really complacent levels, and you can really see that here with the CBOE options equity put call, and you can see here I actually have this label down here where we're at extreme complacent levels that we have not seen since 2011. Just something to keep an eye on. It's not a time to be extremely invested. It's certainly not a time to be on margin. I wouldn't even recommend being fully invested right now. But let's see here. What else did I want to show you? You can see here this is the NASDAQ chart, but what I wanted to point out here is the Keltner channels were above on all of the indexes. Something to definitely keep an eye on. At this point, what would get me back interested in the markets? I think two things would have to happen. Either we would have to have a really explosive move to the upside based on some sort of new macroeconomic catalyst, and that would probably get us into the parabolic phase. And at that point in time, I would like to see a little bit of a pullback, and by then I would probably start to see new stocks showing up on my momentum scanners. The other thing is a pullback, a decent pullback in the indexes that scare enough people that you start seeing things like the bull market is over. That's kind of what I'm looking for.